Warning, I estimate the probability of a US recession by the third quarter of next year at more than 90%. There will be no soft landing. The S&P 500 is likely to tumble at least an additional 25% to around 3,000 to 3,100, and the risk to that target is frankly to the downside, possibly much lower. The recent bounce in the market, in fact, is just another bear market rally, much like the move we saw last summer. And I'm looking for that bounce to lose steam before year end. And perhaps the worst part of all is that the Fed, the Federal Reserve, is totally irrelevant to all of these forecasts. There's nothing the central bank or politicians in Washington, D.C. can do to stop what's coming. Indeed, despite what you're probably hearing from many pundits in the financial media, when the Fed does pivot, it's likely to be bad news. Very bad news for the stock market. If you want to avoid the fallout from the coming economic and market mess and actually build your wealth over the next few years, the time to act is now. Hi, my name is Elliot Yu, founder of the Creating Wealth Advisory Service. Listen, I know these forecasts and warnings may seem pretty dire, and you're probably hearing the exact opposite from many popular financial pundits out there. However, my research confirms the Wall Street consensus, the investing crowd, as it were, is ignoring the fallout from three dangerous market myths. Market myths that have cost investors like you and me a ton of cash over the years, and could lead to a real wipeout for Americans' retirement savings in the new year. The good news is that there are some simple steps you can take if you're willing to act quickly to both protect your wealth and hard-earned savings and actually generate some impressive profits over the next few years. So I recorded this video presentation today with two basic goals in mind. First, I want to cover in brief the three common yet extremely dangerous and very, very expensive market myths I see right now. Myths that could literally wipe out the savings, income, and retirement dreams for millions of Americans over the next 12 months alone. The worst part is that some of these myths are so common and so often repeated that they're accepted as fact by the so-called experts in the financial media these days. So I urge you to bear with me. Examine the facts, charts, tables, and evidence I'm about to present, and then decide for yourself whether I'm for real or just full of hot air. Second, I want to detail 5 specific profit steps I'm recommending to readers of my Creating Wealth Advisory Service right now. In fact, I'm going to do something I've never done before and literally give you the exact recommendations and symbols for some of the specific stocks and exchange-traded funds, ETFs, I'm recommending in Creating Wealth right now. So I'll get to those five profit steps here in just a few moments. However, first I'd like to start with this. Myth number 1, the 58th point inversion. First up, check out this chart. This chart shows the slope of the US Treasury yield curve since January 2nd, 1962. As a blue line. To define the slope of the yield curve, I've subtracted the yield on the 3-month US Treasury bill from the yield on the 10-year US Treasury bond. When this measure dips below 0, the yields on short-term T-bills are higher than longer-term Treasury bonds. That's called an inversion in the yield curve. I've also shaded in gray all US recessions since 1962, the start of my chart. Finally, the yield curve on this basis recently inverted by as much as 58 basis points, which is negative 0.58%. So I've marked this level of inversion as a horizontal orange line on the chart that I'm showing you. In recent months, I've heard and read several prominent market pundits and talking heads in the mainstream financial media holding out the hope the US economy might avoid recession in 2023 and experience the historically rare so-called soft landing. Some so-called experts may also tell you the yield curve has been quote-unquote wrong in the past, inverting without signaling an imminent economic contraction. However, a quick glance at this chart reveals one key point. In the past 60 years, the yield curve has never inverted by 58 basis points or more without correctly signaling recession. In July 1973, the yield curve signaled on this basis by inverting more than 58 basis points, just 4 months ahead of the start of the vicious recession in November 1973. Again, in late May 1979, it signaled again, with the recession starting in January 1980, about 7 months later. It signaled at the end of August 2000, 6 months ahead of the March 2001 recession. And the 58 basis point inversion was about a year early, signaling the 2007 to 2009 Great Recession. This indicator signaled again this year on November 28th, which leaves two basic choices. Either the yield curve is wrong for the first time in more than 60 years, as far back as we have data on this metric, or two, the US economy will slip into recession sometime between March and November of next year. Now, in my experience, when I hear an argument which starts with some version of the phrase, hey, this time is different, it's time to run in the opposite direction. The yield curve works as a recession prognosticator because a deeply inverted curve signals tight Federal Reserve monetary policy alongside market fears about US economic growth. That just about sums up the current situation. And that brings me to the topic of endless debate in the mainstream media since this June. Market myth number 2, buying Fed pivots. Now, one argument I'm hearing a lot from the bulls lately is that inflation is easing, and the Fed will likely be able to pivot away from its tightening stance in early 2023. The argument goes that since rising rates have been the main headwind for stocks, this pivot would send the stock market sharply higher again. To define a Fed pivot, let's look at weekly data on target Fed funds rates around US recession since 1972, when the Fed funds target rate falls by more than 75 basis points from a cycle peak level. During or just ahead of a US recession, that constitutes a Fed pivot in my book, in favor of looser monetary policy to combat weak economic growth. Take a look. The history lesson clear from this table: investors should look to sell, not buy Fed pivots. The reason is that the Fed usually only truly pivots on rates when a US recession is already underway or is imminent. And typically Fed pivots, even when they happen before the absolute peak of the bull market, are not good buying opportunities. Indeed, the average decline from first Fed pivot to absolute bear market low since 1972 is a whopping 28.7%. And the smallest decline in the past 50 years has been about 10%. If anything, buying Fed pivots has become even more dangerous in the 21st century. The S&P 500 plummeted more than 40% following the Fed's early 2001 pivot in favor of cutting rates, 52.5% following the Fed's November 2007 pivot, and 26.22% to the March 2020 bear market low after the Fed pivoted actually in late 2019 on this basis. In the rare instances where the Fed has pivoted and the US economy has avoided recession, early 1996 is one example of that, the stock market has tended to rally. However, see my first chart that I mentioned earlier on the yield curve. The probability of a soft landing scenario is fast approaching 0 this year. Finally, that brings me to the following doozy of a market myth, maybe the most dangerous of all. Myth number 3, growth and technology stocks are recession resistant. More than a decade of ultra-easy monetary policy and the fiscal and monetary bazooka approach to the coronavirus outbreak of 2020 inflated a series of speculative financial bubbles that were ticking time bombs long before price inflation began to be an issue in 2021. In this case, ultra-easy monetary policy inflated the value of stocks with limited earnings, profits, and free cash flow, but the sort of hope for strong long-term and recession-resistant growth prospects. For example, at the peak in September 2021, Snap Inc., which trades under the symbol SNAP, the parent company of social media app Snapchat, attained a stock market valuation of more than $130 billion. Despite the fact the company lost $488 million in 2021, a projected $1.12 billion this year, 2022, and $1.32 billion projected for next year, 2023. Let's put that in perspective. At its height in 2021, Snap had a higher market valuation than Citigroup, one of the largest banks in the world that generated some $22 billion in profits last year alone. It was worth more than the gross domestic product of Kuwait. That's unjustifiable based on any logical, relevant concept of business value. Such valuations are only attainable in the bizarro world where capital is artificially rendered free, causing markets to cease functioning properly as allocators of capital. Over the past 13 years, literally trillions of dollars of capital has been funneled into stocks like Snap, with limited potential to produce real earnings and cash flows, while companies that produce vital, in-demand products and commodities were out of favor and starved of that very same capital. For example, a capital squeeze for energy companies has led to a shortage of oil and natural gas on the global market right now and soaring prices. Do you really think that's an efficient use of capital? Really, does creating a new feature on a social media application like Snapchat, or Facebook for that matter, mean more to your personal well-being than affordable energy and our national energy security? It's all coming unraveled right now. One example is the collapse in stocks like Snap, now down more than 88% from its highs of a little more than 1 year ago. And here's a second example to watch. This chart shows consensus year-over-year earnings growth estimates for the S&P 500 growth and value indices for the next 2 quarters. That's Q4 2022 and the first quarter of 2023. One of the rationales used to justify sky-high valuations for growth stocks in recent years is that growth was really somehow defensive. The idea was that even during recessions, growth stocks like Amazon and Microsoft could show positive earnings growth, while stocks from more cyclical value industries like energy and financials would get hit hard. However, note that year-over-year earnings growth for growth stocks in the S&P 500 for both Q4 of this year in the orange line and Q1 of 2023, that's the yellow line, are now projected to be negative 13.6% and negative 5.8% respectively. Estimates have declined significantly since July of 2022. Even more important, Q4 2022 and the first quarter of next year, growth for supposedly cyclical value stocks is predicted to hold up far better than for allegedly defensive growth stocks. Simply put, as the illusion of defensive, recession-resistant growth meets the economic and business realities of the global economy these days, growth stocks simply won't be able to maintain their still elevated valuations relative to the broader market S&P 500 and value indices. Of course, the most important part of this presentation isn't just what's happening in markets today, but what you can do about it. And that brings me to this, profit step number 1, bubble, boom, and bust. Maybe or maybe not, you recognize this man. This is Sam Bankman-Fried, the co-founder and now former CEO of FTX, one of the largest cryptocurrency exchanges in the world, until recently that is. Sam Bankman-Fried, known by many solely by his initials FBF, had a net worth of more than $26 billion back in late 2021. He was one of the richest men in the world. And more than $10 billion as recently as October of this year, 2022. He was the second largest individual donor to Joe Biden in the 2020 election cycle. In September, he reportedly offered $5 billion to Elon Musk to help finance the acquisition of Twitter. He reportedly invested more than $500 million into various venture capital firms. Yet, in November 2022, FTX and a long list of associated companies filed for bankruptcy protection, and SBF's entire personal fortune was wiped out in a matter of less than 1 week. It's an event Bloomberg called one of the greatest ever destructions of wealth. The legal term for FTX's new management appeared in a Delaware bankruptcy court just last week and had this to say about the company Sam Bankman-Fried built. Quote, FTX was in the control of inexperienced and unsophisticated individuals, and some, or all of them, were compromised individuals, end quote. Lawyers went on to say that, quote, a substantial amount of FTX's assets are either missing or stolen. FTX's new CEO, John Ray III, who, by the way, also helped to sort through the collapse of Enron about 20 years ago, said in court papers that, quote, corporate funds were used to buy homes for employees in the Bahamas without any form of internal documentation. And what's even worse is that it's not just SBF's personal fortune that was wiped out. Hundreds of thousands of individual FTX customers, including smaller ordinary Americans who traded cryptocurrencies through FTX, have now been frozen out of their accounts and may never recover any of their assets from the firm. Sam Bankman-Fried also used his personal stakes in FTX and related companies, now near worthless tokens created by these companies, and other questionable assets to back up billions of dollars in loans. Of course, this is also characteristic of most bubbles in history. Tulips in the 17th century Holland, mortgage credit before the 2007 to 2009 Great Recession, dot-coms in the late 1990s, and now cryptocurrencies like Bitcoin. All were powered, at least in part, by easy credit. Massive borrowing and the collapse of these bubbles resulted in serious losses across the financial system. Overly aggressive speculators like Sam Bankman-Fried, who experience a breathtaking, dramatic rise, followed by an equally dramatic decline in wealth, heroes to some in the boom years and villains thereafter, are just part of the process. Well, my point is that once bubbles like Bitcoin burst, they typically never again attain their former heights. Take a look. This chart shows the price of the world's largest cryptocurrency, and again, that's Bitcoin, from the end of 2015 through to late November of 2022, this year. As you can see, Bitcoin traded well under $500 in late 2015 and through much of 2016, averaged about $7,400 in 2019, and then exploded to as high as $68,991.85 about a year ago in November 2021. Since then, it has collapsed 77% from its 2021 peak. Yet it remains at about twice its pre-COVID trading levels. The tenfold increase in the price of Bitcoin from less than $7,000 at the end of 2019 to a peak of near $70,000 in November 2021 is a classic bubble. Prior to the 2020 easy money binge, Bitcoin sold for around $7,000, and I expect the cryptocurrency to at least decline to that level in coming months. And the risk is that it goes lower, much lower eventually. You see, in late 2018, the last time the Fed was raising interest rates, Bitcoin traded below $3,200. I wouldn't be at all surprised to see it retest those lows in the first half of next year. Listen, I don't have time to go through all my research on Bitcoin in this short video presentation. Suffice it to say that I think this bubble asset has much further to fall. And one of the recommendations I've made in creating wealth is to buy units of the ProShares Short Bitcoin Strategy ETF, which trades under the symbol BITI. The BITI ETF is designed to rise in value by 1% for every 1% decline in Bitcoin futures prices. It gains value as Bitcoin loses value. Simply put, I recommended a small initial stake in this ETF in the Creating Wealth portfolio and have been adding to the stake in the model portfolio on any bounces in the price of Bitcoin. As the bubble market unravels, I expect Bitcoin to fall much further, and for BITI, the ETF that tracks the inverse of Bitcoin, to rise in value. And Bitcoin is just one of what I like to call busted bubble assets I've identified in the Creating Wealth portfolio. I've been using inverse ETFs like BITI to profit from the collapse of these dangerous busted bubbles. In just a moment, I'll show you how to gain access to all my recommendations in the model portfolio with no risk or obligation. However, first, that brings me to this. Profit step number 2, risk off fixed income. The stock market has had a tough year this year. with the S&P 500 down about 16% and the NASDAQ 100 off a whopping 29.7% year to date. However, that's not the worst thing about this year. Take a look. This is data from NYU's Stern School of Business showing real, that is inflation-adjusted, returns from the S&P 500, including dividends, for every year since 1928. As a blue bar, those are the blue bars, and inflation-adjusted returns from holding the 10-year U.S. government bond, the 10-year Treasury, as an orange bar. I've used Bloomberg to approximate the data on a year-to-date basis so far in 2022. Now look at the data so far for this year. In 2022, the inflation-adjusted return from the S&P 500 is around negative 26% because of the poor stock market performance I mentioned earlier, as well as the sky-high inflation rate we're seeing year over year right now. So as you can see, real returns from holding stocks this year are pretty terrible. Yet there are years since 1928 that have been far worse than 2022 on this basis. 2008 is one example, a few years here back in the 70s, and of course amid the 1930s Great Depression. However, here's what's even worse. Thanks to the Fed's aggressive rate hike campaign to combat inflation, fixed income investors have also been crushed this year. The return from holding the 10-year Treasury bond, U.S. government bonds, is around negative 22% on the real basis this year. On an inflation-adjusted basis, that's the worst return from holding the 10-year Treasury bond for any year since at least 1928. The combined effect is devastating. You see, if you look at the weak years for the stock market, again, 2008 is a good example, you often find that bonds perform pretty well. So in 2008, the S&P 500 was down more than 36%. However, the good news was that if you bought a 10-year Treasury bond that year, you were up almost 20%. In short, Treasury bonds were a good place to hide. Much the same can be said for the Great Depression years in the 1930s. As you can see from my chart, there were some very bad years for the stock market in the 1930s, as most of you know. But in bad years for the stock market, investors could still have generated something of a positive return from buying treasuries. There are very few examples visible in my chart where the bond and stock market both experienced severe hits in the same year. Very few examples where both the blue and orange bars on my chart were negative since 1928. 2022 is a standout, and not in a good way. Since 1928, there's never been a year where both the bond market and the stock market have fallen on a real basis to the degree that's happened this year. This is a huge economic problem, and it's truly a scary trend for Americans that are close to retirement. That's because so many investors save for retirement by investing a portion of their wealth into stocks and a portion into government and corporate bonds. Now, the sort of rule of thumb, if you will, of many investment advisors over the years is to increase allocations to so-called safe havens fixed income, bonds, as an investor gets older, while reducing exposure to stocks. Now, the idea is that stocks are more volatile, but offer stronger returns over the long haul. Now, that's beneficial for younger investors with decades of working life ahead of them to recover from stock market declines. As investors age, bonds offer a safe haven with stability of principal. The proliferation of so-called target date retirement funds that sort of automatically adjust assets invested in stocks and bonds with a specific target date for retirement in mind are just one popular example of this sort of stock-bond hybrid investment strategy. Unfortunately, a combination of sky-high inflation and poor returns from both stocks and bonds has upended this strategy in 2022, leaving investors with few places to hide from the carnage. So why has this happened? Well, the simplest explanation is that the Fed normally hikes interest rates when the economy is strong. When that happens, there's downward pressure on bond prices, but usually corporate profits are strong. Historically, a strong economy and strong corporate profits drive the stock market higher. Also, when the Fed is cutting rates, that usually means the economy is weak. That's a headwind for corporate profits and the stock market, but obviously a tailwind for bonds. However, much of the big rally in stocks in 2020 and 2021 was driven by easy money, not rising corporate profits. Indeed, some of the biggest gains in the stock market were names with limited profitability, but lots of hype and excitement around future growth potential. Snap Inc., for example, the parent company of social media website Snapchat that I mentioned earlier, lost 65 cents a share in 2020 and 31 cents a share in 2021, yet the stock soared 408.94% from the end of 2019 to its highs in September 2021. Zoom Video Communications, the company behind the popular webinar service of the same name, produced earnings of just 27 cents per share in 2020, yet traded as high as $568.34 per share in October of the same year, a whopping 2,105 times earnings. The stock was up 395.8% in 2020 alone. The problem with this is that as the Fed started to raise interest rates earlier this year, that hit bonds as you'd expect, but it also obliterated the valuations for the very growth stocks, names like Snap and Zoom, that were leaders of the stock market rally back in 2020 and 2021. So even though the US economy and corporate earnings remained on pretty solid footing through much of this year, the stock market actually fell as rising rates reversed the junk and growth rallies of the past 2 years. My research confirms that we're now entering a crucial phase of the market and economic cycle that's bringing this bizarre world of coordinated stock and bond market losses to an end. Simply put, the market's main focus has started to shift from rising interest rates and Fed policy, the driver of the big stock market rally in 2020, 2021, and the collapse in 2022, to the health of the US and global economies and corporate profits. I must warn you, as I'll explain in just a minute, this is very bad news for the stock market as a whole. However, as the economy weakens and enters recession, it does mean the Fed will slow and then pause rate hikes. By late next year, or maybe early in 2024, I'd also expect the Fed to be cutting rates again to support economic growth. Historically, this phase of the economic cycle, where concerns shift from rates to growth, marks the start of at least a multi-month period of strong performance for treasury bonds and certain other types of fixed income investments. In short, I'm looking for some types of bonds to resume their traditional role as a safe haven during bear markets in the S&P 500. And I've added a series of ETFs tracking the bond market to the model portfolio and creating wealth. Warning, not all bonds will benefit from this safe haven trade. Indeed, I am very bearish right now on certain corners of the fixed income market that I believe could be vulnerable to additional downside of 20% or more next year. I'll show you how to gain immediate access to my favorite fixed income exchange traded funds and exactly how I'm recommending you approach this market in just a few moments. However, before I get into that, let me tell you about profit step number 3. Changes in the cycle, changes in market leadership. In this presentation, I've talked a lot about risks. The risk of significant additional declines in the broader stock market over the next 6 to 12 months. The risk of a painful recession in the US. The unprecedented synchronized sell-offs in stocks and bonds this year that has poleaxed popular equity and fixed income strategies such as target date retirement funds and ETFs. Even the risk of devastating wealth destruction and what I like to call bubble assets like Bitcoin. However, there's a silver lining, if you will, to the current market and economic mess. You see, historically, bear markets destroy wealth. Yet they also represent far and away the most important and profitable part of the cycle for investors like you and me. Simply put, recessions and bear markets historically represent changes in market leadership. And if you follow the signs, the potential long-term returns can be breathtaking. Take a look. This chart shows the relative strength of the S&P 500 Information Technology Index to the S&P 500 from July 6, 2007 through the end of 2009. Now this period covers the end of the 2002 to 2007 bull market, the entire 2007 to 2009 vicious bear market, and the beginning of the 2009 to 2020 bull market in the S&P 500. When the line on this chart is rising, tech stocks in the S&P are outperforming the broader market and vice versa. In this case, the S&P 500 peaked in October 2007 and bottomed in March 2009. However, the relative strength for technology compared to the rest of the S&P 500 actually bottomed in late 2008. And by the time the broader market bottomed in March 2009, tech was clearly breaking out on a relative basis to the S&P 500. Now in the subsequent bull market, March 9th, 2009 until February 19th, 2020, the S&P 500 Information Technology Index soared 951.5%, compared to just a 528.13% gain in the S&P. That's outperformance of more than 423 percentage points. In short, investors who recognized tech's outperformance in late 2008 and assembled a position in big technology stocks on dips in the final 3 or 4 months of that bear market would have enjoyed market-beating gains through the entire ensuing bull market, which lasted almost 11 years. Just as in December 2008, I believe virtually all stocks have some additional downside to come before this market finds a true bear market bottom. That's a warning. However, it's just as likely that some stocks, now these are the likely leaders of the next big bull market, have relatively limited additional downside from the current quote and are far less vulnerable to selling pressure than the S&P 500 as a whole. These same stocks and groups could also outperform the S&P 500 in the next bull market by hundreds of percentage points, just as tech did in 2009 to 2020. Obviously, if we could determine the date and level at which the S&P 500 would bottom, then we'd recommend holding the inverse ETFs until that date and flip to all in on the best positioned sectors thereafter. However, that's a fairy tale and no one has a crystal ball. While we can and do monitor short and long-term market and economic indicators for clues, none are infallible. So it's now time to start. Only start identifying stocks, sectors, and exchange-traded funds that we believe could be leaders in the next bull phase for the stock market. And just as important, it's time to start identifying specific levels, I'm talking about price levels, where we believe buying those stocks or ETFs represents a solid opportunity for investors over the intermediate to long term. In this way, we can take advantage of any panicky market-wide sell-offs over the next several months to assemble positions in these new market leaders. There are 2 parts to this process. First, identifying sectors set to underperform, and second, of course, identifying the sectors and stocks to buy on the dips. So let me tell you about part 1 of this process here, and then I'll cover specific stocks and sectors my research confirms could be the leaders of the next big bull market. These are names you should be looking to buy on dips into early next year. In creating wealth, I generally recommend using inverse ETFs to actually profit from the downside in vulnerable market sectors. And of course, you'll want to largely avoid these vulnerable sectors even after the broader market bottoms. You see, it usually takes a decade or more for stocks leading bear markets on the downside to recover. For example, following the so-called tech wreck in the year 2000, technology stocks underperformed the S&P 500 for a decade. An investor who bought the NASDAQ 100 in March 2000 didn't even break even on that buy until late 2016, 16 years later. So generally, the most vulnerable sectors over the next several years will remain the technology and growth stocks that led the bull market from 2009 to 2020, and then really exploded to the upside in 2020 and 2021. In creating wealth, I generally have been recommending readers assemble positions in inverse ETFs targeting these sectors on bounces, and then take profits on the big bouts of selling we've seen in months like September of this year. I don't have time in this short presentation to go through all the specifics of this strategy. However, I'll explain a bit more about how you can gain access to this strategy free of risk or obligation in just a few minutes. First, however, I want to cover one of the groups and a specific stock I'm recommending readers look to buy on dips in the coming months. Profit step number 4, regional banking buys. So far this year, there's been a massive gap in performance between regional banks and other widely followed indices of financial stocks. Now this chart shows the cumulative total return for 3 indices since the end of 2021. The KBW Bank Index, the KBW Regional Bank Index, and the S&P 500. As you can see, two of these indices have performed similarly this year. Through the close on November 22nd, the S&P 500 is down about 15%. And the KBW Bank Index is off even more than the broader market, down 16.6%. Yet the regional bank index is actually up about 1% so far in 2022. And my favorite regional bank to buy right now, I'll give you the details and the symbol for this bank here in just a moment, is up 19.3% this year. The KBW Bank Index is dominated by the largest U.S. financial institutions, including the likes of JP Morgan, Citigroup, and Bank of America, which are all down significantly this year, falling 11.6%, 14.9%, and 14.2% respectively. The regional bank index generally includes smaller U.S. banking institutions. The three largest banks in the index are Cullen/Frost, Webster Financial, and Commerce Bank Shares, with market capitalizations of $9.3 billion, $8.54 billion, and $8.31 billion respectively. Compare that to JP Morgan's $345 billion market cap, or Bank of America's $301 billion. In short, I believe regional banks are dramatically outperforming other larger U.S. financials because they're typically focused on one simple business, namely lending primarily to U.S. businesses and consumers. Banks like JP Morgan and Citi derive significant revenues from businesses like securities sales and trading, asset management and investment banking, and they have global businesses. Meanwhile, regional banks, like my current favorite, which is Cullen/Frost, trading on the NYSE under the symbol CFR, which I'll put right here, primarily focuses on taking in deposits and lending out that capital to businesses and consumers in their local or regional markets. Now, in Cullen/Frost's case, that's Texas. The basic banking business is pretty simple. A bank takes in deposits from businesses and consumers and pays out some interest on those deposits. The bank then turns around and lends out that capital to businesses and consumers at much higher rates. The difference between the interest rate paid on deposits and the rate received on interest is called the net interest margin. In CFR's case, the profit generated from lending, net interest income, has been about $1.024 billion over the past 12 months, ended June 30th, 2022. One of the main takeaways from the experience of the past 15 years since the Great Recession and financial crisis of 2007 and 2009 is that the simple age-old banking business totally breaks down in a world of near zero interest rates and quantitative easing. This chart shows data from the Federal Deposit Insurance Corporation for the average net interest margin for all FDIC-insured financial institutions since the first quarter of 1984. Now that's the orange line. I've also overlaid a quarterly plot of the 3-month T-bill yield over the same time frame. That's the blue line, which is a good proxy for short-term interest rates in the US and the frame of Fed policy. Note the experience of the past 15 years. During the financial crisis of 2007 to 2009, the Fed cut interest rates to zero, and then, starting in 2008, embarked on several rounds of quantitative easing. Fed policy rates and short-term US interest rates remained stuck near zero for much of this period until 2015-2016, when the Fed started to hike rates and eventually began to shrink the size of its balance sheet, known as quantitative tightening. As you can see, net interest margins for US banks initially recovered as the 2007 to 2009 recession ended and the economy recovered, but then peaked and began a long slide to reach a low of 3.02% in the first quarter of 2015. NIM's, net interest margins, then recovered as the Fed tightened policy from 2015 to 2018, reaching a peak of 3.48% in the fourth quarter of 2018. While well off the 2015 lows, even at the peak in 2018, US interest rates were still very low by historical standards. Monetary policy was still very accommodative, and the net interest margin peak was modest compared to levels seen for much of the period covered by this chart. And that brings me to the more recent 2019 to 2022 era, when the Fed began to cut interest rates and, in reaction to the coronavirus outbreak in early 2020, unleashed an unprecedented wave of monetary stimulus. The COVID response included slashing interest rates to zero again and unleashing by far the largest round of quantitative easing in history. bank net interest margins predictably collapsed to the lowest levels in the near 40 years covered by my chart, reaching a low of just 2.5% in the second quarter of 2021. At the hard right edge of my chart, you can see the big ramp in T-bill yields to 3.25% as of the end of September, and they're now closer to 4%. And the FDIC data shows bank net interest margins recovering to 2.8% by the end of June, and the banks that have reported to date have indicated further increase in their net interest margins. Now, my big picture view is that we're seeing a return to a more normal economic and credit market environment. Clearly, the Fed has hiked interest rates this year at a pace that few would have predicted even just a year ago, in response to the biggest and most persistent surge in inflation since the 70s. And the Fed is now reducing the size of its balance sheet, a process, as I said, known as quantitative tightening. Since a mid-April peak, the Fed's balance sheet has tumbled by more than $206.5 billion. And the pace of quantitative tightening has been ratcheted higher to $95 billion per month. Bank reserves, arguably the most important number to watch when the Fed tightens policy, have plummeted by more than $1.3 trillion, trillion with a T, since a peak in early December 2021, to hit the lowest level since the autumn of 2020. Still elevated inflation will keep pressure on the Fed to maintain higher rates. And while I do believe the Fed will ultimately pivot on rates next year as the economic picture deteriorates, the growing negative side effects of near zero and negative interest rates in the US and Europe in recent years will render central banks loath to return to extreme policy accommodation anytime soon. Inflation is likely to recede, but I suspect we won't see prices rising near the Fed's 2% target for long over the next few years. And that brings me back to Cullen/Frost and why I'm recommending this particular regional bank. Now, around 40 to 45% of Cullen/Frost's total loans are floating rate commercial and industrial loans, which is well above average for the regional banks. That means rising interest rates quickly feed through to CFR's profits by boosting the interest rates charged on loans and, by extension, net interest margins. I also like CFR's geographic focus in Texas. That's partly due to the fact Texas is a business-friendly state that's generally seen above average economic growth over the years, but also because of the state's large energy industry. Indeed, as you might expect, CFR's long history in Texas, it was founded back in 1868, means it has a core competency in lending to energy firms, including upstream, producers, midstream, pipelines, and downstream, which is refining and marketing firms. And that brings me to another group of stocks I'm recommending readers buy in creating wealth. Stocks that will benefit from what I believe will be the profit step number 5, the multi-year commodity supercycle. You're probably well aware of the surge in commodity prices over the past 18 months or so. Oil prices soared well above $120 a barrel earlier this year. Natural gas prices reached levels not seen in over a decade in the US and touched record highs in Europe. US corn prices reached over $8 a bushel, close to the highest level of the past 60 years. My research confirms these moves are actually just the start of what's likely to be a multi-year commodity supercycle. And like most of the biggest commodity bull markets in history, this one will be driven primarily by supply. Specifically, the supply of all sorts of commodities just isn't rising fast enough to keep pace with global demand. And the main reason for that is lack of investment. You see, low prices for many commodities, from corn and wheat to oil and gas, lulled the world into a false sense of resource security. In some cases, such as in the US and Europe, governments actively discouraged investments in fossil fuel production capacity as part of an effort to reduce carbon dioxide emissions. The result, companies just haven't invested enough in producing these critical energy, agricultural, and metals resources over the past 5 to 10 years, and it will take at least 5 more years to bring new supplies online in some of these markets. So I believe this commodity inflation will cause plenty of economic problems over the next few years, much like the stagflation period of the 1970s. However, it is a boon to any company that produces these key commodities. Now, I don't have time to go through all my key commodity recommendations in the Creating Wealth Model portfolio in this short video presentation. Suffice it to say, I'm already making recommendations in a broad list of stocks, including a precious metals play with low production costs and a 5% dividend yield, one of the world's largest fertilizer producers with a rock-solid, sustainable competitive advantage, a natural gas producer that's on track to offer a more than 10% dividend yield in 2022 and something similar next year. So there you have it. In this short video presentation, I've explained why my research suggests there's significant additional downside to come for stocks in 2023. How the S&P 500 could fall to as low as 3,000 to 3,100, perhaps even more, and why the US economy is headed for recession. And I've outlined 5 specific profit steps I'm recommending to both protect and grow your wealth through what's likely to be the most challenging economic and stock market environment since at least the 1970s. I outlined my strategy for the broad market, how to profit from the collapse of bubble assets like Bitcoin, my favorite regional bank to buy on dips, and my outlook for commodity prices. Early on in this presentation, I promised you I'd explain how you can gain access to all of my research immediately with no risk or obligation. Here's how it works. I've authorized my team at my publishing firm, Capitalist Times, to open up risk-free trial memberships to my Creating Wealth service at the lowest price we've ever offered. That way you can follow along with exactly what I'm recommending in real time, and you'll be the first to know of any changes to my recommended model portfolio via immediate and frequent flash alerts. In fact, in recent days, I've added several recommendations to the service, stocks and ETFs that I believe require your urgent attention. I'd like to rush those recommendations to you today, right now, as part of your risk-free trial. Here's how it works. To activate your risk-free trial right now, simply click the button adjacent to this video. That'll take you to our risk-free, secure order page where you can start your trial at the lowest price we've ever offered of $299 per year. As soon as your trial is confirmed and you accept my invitation, I'll rush you the last 2 issues and alerts for Creating Wealth, published in recent days, including my latest recommendations in PDF format directly to your email. After that, you should expect to receive at least 2 issues of Creating Wealth each month, supplemented by frequent flash alerts with new recommendations, advice or updates on existing recommendations. You'll also have access to my members-only email if you have any questions. Try the service for the next 60 days, 2 full months, and if you don't believe it's worth every dime of the subscription price, simply call or email us to cancel your subscription for a full refund of your $299 subscription rate. I guarantee it. Thanks for your attention today. I look forward to welcoming many of you as new members here in just the next few minutes. To activate your risk-free trial right now, simply click the button adjacent to this video or give us a call toll-free on 1-877-302-0749 anytime between 9 a.m. and 5 p.m. Eastern. Again, that number is 1-877-302-0749 anytime between 9 a.m. and 5 p.m. Eastern Time. Thank you very much for listening to me today.